The bond market is worried about the budget. The budget is a big deal. The budget, the government spending is the single source of inflation in America.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Tulum. We are live at our President's Cabinet at Tulum at the Conrad. The Conrad is kind of like the St. Regis line of the Hilton chain. And we are having our awards trip. We're here Monday through Saturday. President's Cabinet. So here we go. It's a little loud. All right, lots going on this week. I had a red eye last night. I have not slept. I literally have not slept since 5:30 a.m. yesterday, and it's like 10 o'clock. Thank God for espresso and espresso martini. Okay, so CPI came out today. Inflation's a big deal. The Fed has a dual mandate, even though it's really a tri-mandate. Remember, healthy employment, full employment, low unemployment, and price stability, which means low inflation. So the CPI is the consumer price index, and it came in at 2.3%. 2.3%. By the way, look at this little infinity pool. Pretty cool. That's the Gulf of Mexico. And CPI came out. Housing inflation was a little lower than expected. If we looked at new rents, which are dropping, which they don't, they have this lagging indicator where they take rents from 12 months ago. So we're using rents, higher rents from 12 months ago into the CPI. If they were using, for this measure, current rents, I mean, we're way under 2%. Anyway, core CPI, which excludes food and energy, which nobody does in real life because we have to pay for all that, but they're excluded because they're volatile. I think we're at 2.8%. So still a little elevated. 0.2 month over month, 0.237, but 0.2. So below expectations, inflation's tame. Now, if the Fed were just looking at inflation, they would be cutting right now. But they're still worried about tariff causing inflation, and rightfully so, because inflation is projected to go up because of maybe a supply chain shock. So because right now, when the Fed would normally be cutting, softening labor, certainly low inflation, but the 2-year Treasury and 10-year Treasury have gone up, and that's because there's still a fear of inflation from tariffs. But on that note, we talked about the UK deal cut last week, the first deal cut with our longest ally, and then they cut a 90-day deal with China. And what's interesting is China was the second deal, and I think what no one's really talking about is we cut that deal with them second. So do the tables turn on Europe between the EU and the US, or any of the other nations that are all down to 10%? And so I don't really know, but it's kind of like two brothers got in the room and said, all right, we've been fighting over finances for a while, and let's hash it out. And thank you for Switzerland, all your chocolate and coffee and all that stuff. They helped broker this deal in a very good atmosphere, and Treasury Secretary Scott Bessent is doing some serious heavy lifting. So we went from 145% tariff on China down to 30%, okay, which includes it's like 10% plus 20% non-tariff policies, okay? And then they went from 125 to 130% down to 10% against us. It's a huge win. Now, it's just 90 days, but it obviously sets up a framework for the two biggest economies in the world to work it out. So the stock market is ripping. I am not a financial advisor. I am not responsible for your losses, only your profits. The stock market is ripping. And, but there's still tariffs. And so I think the overall tax rate, tariff rate, as of this point, which has been coming down from the worst case scenario on Liberation Day, we're at 12%, 13%. Overall tariff rate for all things, all economies, everything combined. And that's still higher than the 2.2, let's call it 3% that it's at. That's the inflation part. That's the part where the Fed is in a wait and see mode. Because even though we've been coming down from the worst case scenario, it's still higher than it was before President Trump and team took office. And, tariffs are viewed by the Fed as a short-term inflationary bump, but they're still in wait and see mode. And if they wait and see through the period when they thought they would normally be cutting right now, and labor doesn't soften and inflation goes back up, we might not see any Fed rate cuts this year. Goldman Sachs is kind of seen as the gold standard, pun intended, on projections for GDP, inflation, all that. They are down from 3 Fed rate cuts this year to 1 in the year, and it is May. Now they raised their GDP guidance to be 1% for the year. That's counting a higher growth of our economy in the second half of the year, and they think inflation is going to be a little sticky as well. So what else is going on? We all know it's expensive with higher rates. The 10-year Treasury is at the high end of the range, right? 450 is kind of the high end of the range. We haven't closed above 450 on the 10-year Treasury, but we are like at 447. And so, will we come back down? When money flows into the stock market, it leaves the bond market, which people who are left with less money investing in bonds demand a higher yield. So there's a money flow, stocks and bonds, stocks and bonds. You've always heard that phrase over the years. It's stocks and bonds. It's because money flows between one and the other. Remember, you risk money on stocks to make money. You put money into bonds not to lose money. And we are in a risk-on phase with the stock market ripping again. I don't know how far it's going to go, but it's definitely ripping. And, the bonds are suffering and this mortgage rates are going up. I am going to walk here. There's no cars, but I am standing on like this platform on this infinity pool, which is super cool. Taxes up 10.4% in the last 3 years, about an average of $247 a month across America. Taxes are making things tougher on potential homeowners, in addition to high rates, which is the big driver of home affordability. And of course, insurance is very trying right now with, all the insurance companies trying to figure it out. So lots of flow of money, lots of stuff going on. The Fed is in a wait and see mode, and they may wait and see right past through a period where they'd normally be cutting had not had this tariff, uncertainty. But thank God we're doing something about trade imbalances and bringing capital investments and bringing balance to the trade agreements between, us and other nations. It's a long-term play, and trust me, we'll benefit for it because we're broke. We're dead-ass broke as a nation, and we're paying out billions to other people, and we need to find a way to balance that out. But if interest rates go up, our interest on our debt that we pay back, which is like 37 trillion, is going to break us still. So, I'm not sure when the 10-year Treasury will come down, but housing is tough. It's spring purchase season. People are buying. There's a lot of inventory. Apps are up, purchases are up, everything is up year over year. The CPI is the lowest it's been since like April of 2021. So, we're in a good spot. We just have to kind of grind through it. I'll just add that China deal in the next 90 days, it seems to be that both countries really want to work something out, and that's a big deal. But yet, the tariff rates and non-tariff rates will still be higher than where we started this year, which the Fed is going to wait and see how inflationary it is, and that's it. Our president's cabinet here is, a very special place where all three channels come together. We have wholesale, correspondent, and retail. We're one of the few three-channel lenders left. We are built by originators for originators, and we bring them all together, bring spouses, and this place is amazing. This is absolutely gorgeous. We've got staying power, and like many other of our colleagues in the business, and it's a time to get rooted. And 25% of our ops staff has been here more than 10 years. It's amazing. Shout out to the Mesa team. Mesa launched, and they are out in the press. It's a credit card and rewards platform that you can earn points for paying your mortgage. That's a no-brainer. If you guys haven't looked at Mesa, look at it. They have a white metal Visa credit card that says homeowner on it. And we're rolling out a co-branded logo card, the first lender to do that. And I invite every other lender and servicer to look at Mesa. Call Kelly Halpern, call Maya Velasquez, call their team. It's such a great concept. In a collaborative effort, we want to make sure that everyone jumps on this train because it's pretty cool. And then Gary Malice and I, we're two of the 4 partners here. We hop on a plane Saturday from Mexico and go straight to New York for the NBA Secondary and National Capital Markets Conference. So see you in New York. Have a wonderful, wonderful week. I'll try and get another video out, maybe with some beach scene in a couple days. Cheers.
Hey, it's KP coming to you live from Tulum. It is Thursday night, and I'm, of course, 20 minutes late for dinner with my partners and their wives, and I'm hustling over there after checking some email, and I want to get some words out to you. So, Producer Price Index came out today, and that's input costs into all the things that we make, and it remains elevated, 3.1% core, 3.3% headline. So energy costs are down. Like, energy costs keep coming down. Food went from like 3% to 2.8%. Food prices are down. Transportation index is down. The month-over-month reading for PPI fell by 0.4%, when it's, supposed to be up 0.3. So, I mean, it's all good things for inflation. So why is the 10-year Treasury yield so high? What is wrong with the bond market? Why on earth are mortgage interest rates elevated at the high end of the range? Now, I'll explain in a second. Give you a little view here. As I walk on these steps, that's water. So I'm walking on water, kind of. Kidding. Would never claim that. This is a bunch of restaurants, sushi place over here, fire pit. We had cigars illegally the other night. The bond market's worried about the budget. So now, I mean, quite honestly, the tariff issue isn't as big an issue. I mean, I have a hot take on it. I mean, I read something that said basically we went as high as 20%. Now we're down to 13%. The April inflation report came out on the CPI. There was nothing there. And this tariff mess is behind us. And there's nothing there. Now, I don't know if I completely agree with what I read on that, because there still could be some lingering effect of tariff policy. Ships take time to come from China, and we're going to have empty shelves. We're going to have more expensive stuff. The Fed has said that they look at tariff inflation as something that's temporary, that they can the economy can swallow. But we've gone from like just under 3% prior to this administration to we're at 13% right now. And by the way, these deals aren't done yet. They're like 90-day deals. But I will say, whether it's a nothing burger or it's going to be something, the bond market is worried about the budget. The budget is a big deal. The budget, the government spending is the single source of inflation in America. We are broke. In case you haven't heard that from me yet. We're broke. We spend more than we make. And it doesn't look like this budget forcing the sale of treasuries, the supply of treasuries, the supply of money, the flow of money. It doesn't look like the amount of money that needs to be bought by institutional investors in Japan and whoever else around the world to trade in dollar-denominated goods. It scares the bond market, which is why the 10-year Treasury is elevated. So if it looks like the Trump 1 era tax cuts will be extended, who's going to pay for that? They call it pay for us. And so, the idea is that we'll just keep growing as an economy, but our GDP is pretty low. Now, Goldman Sachs has reduced their recessionary projection from 45% to 35%. They're like the gold standard. We talked about it in a video 2 nights ago. And so if we don't have recession, we have growth. But do we have enough growth to offset all the treasury supply that's going to come on the market? The bond market, for now, doesn't think so. Labor's still holding tight. It's pretty decent. And inflation, obviously, is coming down. So if the Fed does some more balance sheet maneuvers or cuts the Fed funds rate, then that would make our debt less expensive. And that would be positive for the bond market. But they're in a wait-and-see mode because the Trump administration gave them a reason to pause even longer. They won't do a preemptive cut. They are scared to death that, cheaper money doesn't fix the supply chain. So if we have a supply chain issue because of tariffs and we have less supply of goods here, cheaper money, cheaper credit cards, cheaper loans, it makes it worse if we have a supply chain issue. And the Fed is always late to raise rates and late to cut. This is historically how they've been. So they're going to wait, because once they continue, it's a big deal. I mean, so that's it. They're in this wait and see mode. What up? They're in this wait and see mode. And Richard Wersch, Americar, our dance contest runner-ups today. We had a bunch of games out by the pool. By the way, shout out to Brad Finkelstein. 35 years at National Mortgage News. 35 years. It's impressive. I saw him last year in Philly walking around. Really good dude. Put out some fantastic content. One of the best journalists in our business, hands down. He's got some great articles and a lot of good stuff lately. So if you're not tuned into him, go ahead and give him a shout and give a look. Anyway, the investments keep rolling in though. So President Trump is in Saudi Arabia securing a $600 billion investment, something crazy like that. I don't know if I got that right. But Vietnam is going to start producing some more stuff, maybe some iPhones, maybe India will. The president's not happy with that. But if it's not done in China, it could be less disruptive for the 65 million iPhones that are sold in America every year to suckers who cannot get off of Apple and be an Android user, like the rest of us. But investments are being secured. This China deal is a big deal. There's just a lot going on, and I don't know if these investments by all these foreign countries and companies, UK buying $10 billion worth of Boeing jets, when will it all hit our GDP? When will it all get that growth here? Consensus is second half of the year or into next year. And will labor have broken? Will reinflation have reared its ugly head because of tariffs before that happens? I don't know. But this budget's going to get passed, and government spending is, even if the budget stays about the same, we don't get too much of an increase from the last budget, it's still highly inflationary. So that's it. I got a bazillion other things I'll talk about, but I'll save you a 7-minute video. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.